The S&P 500 just hit a new all-time high. So here we are, September 5th, 2025. You can see the S&P 500 just hit roughly 6471. And naturally, when the S&P hits all-time highs, everyone wonders, is now the right time to invest, or should I wait for a market pullback? In today's video, we're going to talk about 3 reasons why it's almost always a good idea to invest, even if the market is at all-time highs. This video is for educational purposes only, not investment advice. It is not an offer or solicitation to buy or sell any security. Investing involves risk. You can lose money. Do your own research and consult a licensed professional before acting. I may hold positions in companies discussed, but will not make trades within 72 hours after publication. Positions may change without notice. Paid promotions or affiliate links may appear. Details will be in the description. Opinions are my own. Data are believed reliable but not guaranteed. CFA and Chartered Financial Analysts are trademarks of CFA Institute. See video description for full disclosure. The first reason you should probably just invest at all-time highs is that returns are actually higher when the market is at an all-time high. So to illustrate, JP Morgan did a research study from January 1968 through December 31st, 2023. And what they found is that the forward returns after the market hit a new all-time high were actually better than the other days. So if you look out 1 year, for example, the years when the market hit a new all-time high 12 months after that, the market returned an average of 13.4%. In the 12 months after a non-market high, the market returned an average of 11.9%. So it was better to buy at all-time highs. The returns were actually better over the next 12 months than they were when the market was not at an all-time high. And the further you go out, the more that was actually true. So if we look out for the 3-year and the 5-year, they found that the 3-year total returns after an all-time high were 48.1%. And that compared with the non-all-time high days of just 40.2%. And after 5 years, the total return after the market's all-time highs was 79.6%. compared with the non-all-time high days of 73.8%. So clearly, just because the market is hitting a new all-time high doesn't necessarily mean that future returns are going to be worse. In fact, the evidence would suggest returns are actually higher, not lower. The second reason is that all-time highs happen actually quite a lot. So if you don't invest at all-time highs, you're going to be missing quite a few opportunities to invest. So for example, here we're looking at just 2025, and as you can see, the market has hit multiple new all-time highs. Quite a few of them have happened in the last couple of weeks. If we look at just 2024, there are actually 43 unique all-time high events. So if you were to avoid investing at all-time highs, most likely you would have not invested the vast majority of 2024. And as we'll see in point number 3, the amount of time and the amount of money you invest is far more important than when you invest it. So number 3 is time is more important than timing. And to illustrate what I mean, I put together a little study. I looked at stock market returns from 1989, which was the year I was born, all the way to 2025, which is the time of this video. So what I did was go back and look at the total return price, which includes dividends reinvested, for the S&P 500 each month going back to 1989, and I assumed 3 different scenarios. In scenario 1, you bought stocks at the absolute market high for that particular year. So for example, in 2025, so far, the all-time high is basically where we are right now, which if you look at the total return S&P 500 is 14,409. The low so far for the year is 10,652, and the average for the year is 13,070. So I made 3 scenarios. One, looking at how many shares of the S&P you could have bought if you had bought at the all-time high. So in this case, you'd have been able to buy 0.83 shares if you had $12,000 to invest. At 14,409, that'll bought you 0.83 shares. If you had invested that same 12,000 at the low for the year, you'd have been able to buy 1.127 shares. And if you had just bought the average price for the year, so just invested roughly $1,000 per month, you'd have been able to buy 0.92 shares. And I did that each year going back to 1989. So you can see the all-time high in 2024 was 13,379, the low was 10,139, and the average was 11,763, and so on and so forth each year, all the way down the page. And so what I found was that if you had bought at the all-time high each year, you'd have accumulated 302 shares. If you had bought at the all-time low each year, you'd have accumulated 443. And if you bought at the average, you've accumulated 336 shares, which at the current market price would have resulted in a fairly substantial difference. So buying at the all-time highs, your $12,000 monthly investment would have grown to about $4.3 million. If you had bought at the all-time low, that would have grown to $6.3 million. And if you had just dollar cost average buying $1,000 per month, it would have grown to $4.8 million. And while that may sound like a lot, and it is when compounded over that long of a time period, the compound annual growth rate difference is actually quite small. If you were the best investor of all time with perfect timing, your compound annual growth rate would have been 11.83%. If you were the worst investor, always buying at the worst possible time each and every year, your long-term compound annual growth rate would be 10.31%. So the difference between perfect timing and perfectly bad timing is only 1.5% per year, which of course, when compounded over a long time period, does make a fairly large difference in total accumulated value. However, when it comes down to it, it's not that big of a gap, number one, and number two, it's definitely not worth the effort, and number three, it's not even possible. No one knows the all-time low or all-time high in any given year. So generally, the best thing you can do is just to always buy. And that's, of course, dollar cost averaging. In that scenario, your returns would have been 10.73% per year. So the difference between just simply blindly dollar cost averaging, buying as much as you can whenever you've got the money, is only 1.1% away from being the absolute best market timer ever. So for the case of your financial future and your sanity, the best thing you can possibly do is just to buy all the time. If you have money to invest, just get that money to invested whenever you've got it. The only situation where you would not want to do that is if you need money within the next, say, 5 years, or maybe even within the next 10 years. That's when you might consider, keeping that more in a shorter term, protective investment like bonds or cash or something like that. But if you don't need money for a decade or longer, the evidence is overwhelming that investing in stocks, even at all-time highs, is a good idea, so long as you hold the shares long enough to see the rewards. So if you're agonizing over whether to put money to work in the stock market or not, hopefully this video helped give you confidence that now of any other time is probably as good a time as there is to invest in stocks. Even if they go through a correction in the next year or two, chances are just staying consistent is the best way to build long-term wealth over time. Also, thank you to everyone who currently supports me on Patreon. I do have my coffee can scorecards coming out for the month of September, so look for those in your Patreon feed. I'll put a link to that PDF packet in the description down below. Thanks for watching, and I'll see you in the next video.